So much like I just outlined with the dollar index, we can see the framework here. We have the market turn here. We rallied up. We had a single down close candle. It traded into this down close candle on the daily chart. That opening price is the very price that causes the change in the state of delivery. What that means is it will now change its directive to now seek premium inefficiency or buy side or a combination of both. So my order block is not a supply and demand zone. I'm looking at the opening price. If it's a down close candle or an up close candle, that is the very trigger. That's the mechanism. That's the price. That is the salient point. That's the bullet point. That's the factor that you're looking at. That's the very thing. That's the key crucial point of information. That opening price. That is going to tell me everything I need to know in terms of where the market's going to reach for, how it's going to deliver, the speed, the magnitude, is it going to continue, and where that order block is in market structure is going to tell me if it's going to be a target, if it's going to be an initial entry, if it's going to be a factor for where my stop loss should be placed above or below, respectively. But that opening price, that is the change in the state of delivery, meaning that now, because what we were doing was we were going lower, seeking a discount. When we went above it, when the narrative suggested that we could potentially turn and go higher, the technical aspects to it is that down close candle and its opening price. Now, watch. We're going to go down to the lower time frames in a moment, but that price is like a trampoline. Think of it like that, okay? When price is above it and Trump trades back down into it, it'll create, if it's good, it will create feedback in price delivery where I call that a signature. If price on lower time frames are supporting or it rallies away from it and then creates a fair value gap above it, I'll take that as a fair value gap entry and go long if it's a scalp and get 10, 15 handles, 20 handles if I can and be done. Market traded down here into that candlestick right there. Same thing, but this is the simple direct right to the point. So that way it gives you useful information. The down close candle, where are we at in respect to the range from here to here? We're still in the discount. Here's the equilibrium price point. So this down close candle is absolutely crucial information for you taking trades. But this is a daily chart. So you have to allow for coloring outside the lines if you're using lower time frames. So it can do a whole lot of things beyond that specific level. But I'm going to show you what you're looking for that constitutes and qualifies a setup. One that you would see me outline, like when I was on Twitter saying, okay, look at this 1 minute candle right now. Go back to this 1 minute candle. At that range, we're looking for that fair value gap. So we have two down close candles here. You have bullish order block in the lower portion of the range, the lower half. Once we get into real close to that equilibrium price point, order blocks can become 50-50. And it really demands your understanding of why you think it should go higher anyway. Because you could see a down close candle at or just above equilibrium, but if you lose the sight of where over here can it trade to, it could be just trading to a short-term premium and then collapse aggressively. This candle's high, that's the draw on liquidity for me initially. Then it's this specific price point here because that's the lowest quadrant that's above the lowest of this fair value gap from that candle's low and that candle's high. That's your fair value gap. So it's this. I'm looking at this range here. But the very specific price points in that range I have based on this. The lower quadrant. And this is not quarters theory, by the way. Okay, it's fine. What I'm doing is I'm grading a price swing. The price swing is the difference between this candle's low and this candle's high. And because the markets are algorithmically booked and delivered, they're going to go to this level, and then they'll go to that level and that level. And how I'm using this information is I want to see a trade here. That would be a nice area to target first. Then if I have a long position on, then it would be this level here where I would take a partial. And then I would take 80% of the trade off at that halfway point. And all right, so we have a 4-hour chart, and here are our respective daily order block levels. Notice that there isn't like 20 of them on the daily chart. 4, 3, or 2. That's good because you're dealing with daily ranges, okay? And the expectance that you may have when you first start doing this is you think order blocks are happening every 5 minutes on every time frame. And you have to be reasonable, because in a protracted price run, that means where it's continuously moving in one direction, higher or lower. In an up move, ideally, you only want to see a few down close candles, because that tells you there's a lot of strength in this up move. If you see a lot of down close candles forming, that means either you're at the consolidation midpoint of halfway of that move, or you're probably near the high. In the next run that goes up, it's going to be, that's the end of it, and it's going to collapse. And that right there, if you didn't write that down, you missed the whole thing today. Because down close candles in a up move, they should only be there for new opportunities to buy. Period. If you start seeing a whole lot of them, that means they're opening the auction up to, hey, look, come on, we want more buyers. And that's the red flag. The more down close candles you see in the time frame that you're trading when you're bullish, the more likely you're at either consolidation, and that's good news if you have a higher time frame objective or target where you think the market's going to draw to. If you start seeing a number of down close candles starting to form around in the general proximity where you're at in price action, you're usually at a consolidation point. That means you're at basically a midpoint of the next price leg will repeat what you just experienced. So it's like a measured move type thing. Think of it like a classic bull flag, okay, where that pause, that little consolidation, is just the midpoint of the overall larger move. And a measured move is just a replication of the first leg up, now will be repeated, but many times it's done so in 3/4 or half the time. So all these down close candles and up close candles or order blocks, they give you intel, not just a entry or a target or a means of managing your stop loss, but it also gives you insight into determining the strength and the underlying probability of the continuation of that price leg or run that you're part of. Ideally, you don't want to see a lot of down close candles, but when you do see them and it does return back to them, you want immediate respect. If you don't get immediate respect, the same thing holds true. You probably are at a turning point, and any rally that comes off of that, the next candle or the next candle after that, within 2 candles of hitting that order block, if you don't get the responsiveness, or if it comes off of it just really lackluster, you're probably only trading up to a short-term premium, which would be model 2022 or a breaker, and then that's it. It's over, and then they're going to pull the rug and it goes lower. Now, how do we use that for very small short-term time frames? Well, we're going to look at how in this little area here where we had that order block, remember on the daily chart, we're at the 4-hour now. Okay, let me go back to the daily. Here's the framework. Here's that last down close candle. So that's these 2 respective order blocks on the daily chart. And they're order blocks because we're in the lower half, or in the discount range of this high to that low. See how that price leg just stands out? It just jumps off of the chart. You're using that as a frame of reference. This is the most logical price run we just had. Now, in that price run, there are smaller price legs. Right now, for daily bias and session bias, this is enough. Okay. So they're order blocks because they're in a lower portion or in a discount relative to the range that you're using to qualify the down close candles to be a bullish order block. And because it's a higher time frame daily chart, they have a lot of influence over price. They're going to be very influential. So having them on your chart and drawing them out like this, what price are we looking at? Well, it's inside the zone. Wrong. It's the opening price. That is the change in the state of delivery. That means that the market will now seek buy side premium arrays or liquidity. That means buy side or buy stops. One of the two or a combination of both. But it's your job to go through the charts and say, okay, now where is there an inefficiency? When it traded down here, you're looking at this saying, oh, see, it failed. That's a noob trying to find fault at something. We're going to get on a lower time frame so you can see what I mean by this. When you have a higher time frame, monthly, weekly, or daily, or even a 4-hour order block, those levels need to be transposed to your lower time frame because they will absolutely have an influence on price. And you're going to see setups that completely have been never noticed by you. But this is a daily chart. We're going to go into these lower time frames. We'll drop down to a 4-hour. Okay, and I want to take your attention into this right here. And I'm going to highlight that in yellow. So when we drop into lower time frames, everything in the yellow is salient to the order block and order flow. We're going to study how price behaves in this area here. All right, so we're on a 4-hour chart. That's all that's necessary on the 4-hour, okay? Everything's the same that we did on the monthly. Everything's the same on the weekly. Everything's the same on the daily chart. And now on the 4-hour, we have a little tiny inefficiency between here and here. Now, when I see something like that, and you're probably thinking, is that really an inefficiency? Yeah, of course it is, because that is touching the old equilibrium. And it didn't come down to at least there. So that is a gap. Okay, that gap, I'll be more mindful to see what that does on a hourly or 15-minute time frame. So I'm not going to worry about framing it on a 4-hour chart. So we'll drop down into a 60-minute chart, which is hourly. All right, now, if you look inside here, we had this candle run above the order block. That's the lowest one on the daily chart. The next candle we drop down. What does it do? It does an immediate rebalance. Now, if you've never heard me teach on this, an immediate rebalance is where the market has a nice big bullish run candle higher, or a bearish candle that has a large range that moves lower. And the immediate next candle after that reprices to the previous candle, to that big candle that just formed. In visual terms, it's this. Market rallied here. This candle went above the order block. That's that opening price on the daily chart, that big blue line there. Okay. When we went above it, the next candle we traded right back down. And what did it do? It went right back to the body or high of the previous candle right before that big candle. So when it does that, what I'm watching is it either will start its run in the direction I'm looking for, which is in this case would be higher. Either that candle or the very next candle. If the next candle does not run and it takes out that low, I am no longer interested in taking along. I have to move to the sidelines. Immediate rebalance is one of the strongest things I have in my repertoire. It will basically be, like, say this candle only stopped with its low right there and didn't go as low as it did there. And it closed and it opened over here. What would it have formed? A fair value gap. But because the market is in such a rush to get somewhere, where this would have been an obvious fair value gap, I'm watching this candle live. I'm watching whatever time frame I'm watching the trade on. I'm looking at how price behaves like this. And when it creates this big run like this and we open up here, I'm waiting to see, does it create a fair value gap? I'm already anticipating. I'm on record doing it. I'm on record calling an inversion fair value gap before they even form. I'm on record expecting an immediate rebalance before they even form. But when it trades down to the high or the body of that candle like it does here, in my mind, if I'm bullish, that's exactly what I want to see happen. And if I can't get in on that candle, as soon as the next candle opens, I'm buying at the market. Immediately, I want to just be in it. Why? Because it's going to perform just like this. If I'm right and everything is equal and I'm on side, that's exactly how the market should behave. The market's going to reprice at that price point and immediately run. And it has nothing to do with this order block. That's just one more qualifying thing for it. It has nothing to do with this breaker right there that's bullish. Low, high, lower, low. Take that range, extend it over here. That's another trade entry. I'm talking about what I'm seeing in price. That candle, when it opens and trades right back down to that candle's high, I'm in it. If I can get in there, I'm in it. Where would your stop loss be, ICT? Low of that candle, or at least the mean threshold of that candlestick's body. That would be this. Watch. That's midpoint or mean threshold. My stop loss has to be below that. And honesty, it would be really at that opening price. That's where I'd have it at. I would not be worried. I would not be panicking. I would not freak out. I would expect it to do this very thing. But the logic is, if we get a big run candle in the direction that we're looking for, the very next candle, I'm waiting to see a fair value gap form. But if we're lucky and fortunate enough for it to come right back down to it there, man, we are in a loaded deal. It's a loaded deal. Why? Why? Did you already forget what I'm talking about already? Where is it forming? What's this blue level? That's that daily order block. It's opening price. It's not a fucking zone. It's a very specific price level. It's not ambiguous. So you need to be looking at that level on a lower time frame. And we're only on an hourly chart. You think it's just a 1-minute chart that I'm teaching students to trade on? No. You want to capture nice day trades you're going to be using the 15-minute and the hourly chart. You want to trade swing trades, you're going to be trading the 4-hour and the 1-hour chart. You want to trade position trades, you're going to be trading the daily and the weekly charts. And the same stuff occurs there. You never, ever, ever need to go below an hourly chart. You don't ever need to do that. But the magic happens when you start applying all these things together that flesh out a narrative. Over here, what's this blue line? That's that higher daily order block, the opening price, not some random level. It's the same level all the time, because that's the change in the state of delivery. What does that mean when ICT says it's the change in the state of delivery? Prior to that candlestick forming, the market was going a direction. It was going lower. It was a move that we called and talked about on April 8th's live stream. I said that we're going to see several hundred handles lower. I didn't talk about going higher, going lower. It was based on seasonal tendency. Because of that, when we have a turn, you don't need to know when it turns. It can stop you out of shorts and prove to you that it doesn't want to go any lower. Then you start measuring what I've showed you here on the daily chart. But if you want to use it to probe any long positions, or if you're confident and convictions are strong enough, you want to be a buyer and hold for longer positions higher, you can key off those daily levels like this. But in short, what's happening is if you have an order block opening price, whether it be a bearish or bullish candle, you need to have those levels transposed to your lower time frames, because you're missing trades. And you're missing many times the best of the best. Now, what happens if you can't get in on this move? Then you have to enter inside this range here, and you may or may not get an opportunity to do so. It just might happen that you don't get an instance where it can come back down and trade below a 1-minute swing low for sell side. It may not have a fair value gap that it trades down into. It may not give you a 1-minute or sub 1-minute bullish breaker. All those things can form inside this. That's why I taught every PD array that I was willing to share, because they all can be used to get into a move that's already started without you. And it will not technically be chasing, because really what you're doing is you're keying off of what a high frequency trading algorithm is going to do anyway. This isn't the only time to enter. This isn't the only time to enter. There's other places to enter, but those other places need to be balanced, because I can take and add into a position that's already established at a lower price when I'm bullish. And that new entry that's being pyramided in, because I'm using smaller position sizes to add more, I can weather deeper retracements on that later entry, knowing that it can do that. I'm not upset by that. It doesn't change my convictions about the trade. It just means that I have a smaller position. It's incurring a little bit more drawdown because I've added more, but I want to be a part of the larger move that's going to happen after that retracement. So let's look at this little piece of action in here. We're on an hourly chart here. So when it dropped down, it touched that higher bullish order block, the opening price. So it's going to act like what? A trampoline. It's going to spring. It's a change in a state of delivery. Delivery is directional price run. That's what that is. So if there's a change in a state of delivery, that means what we're saying is there's going to be a change in the direction of price. So if it was dropping, when it went down into this level here, went lower, lower, and then we round above it, this candle, the first return back into it there, what is it coupled with? It's coupled with an immediate rebalance. It's a bullish breaker with this candle here. A breaker is when you have a low, high, a lower low that takes out sell side there, and then rallies through it. As soon as we come back down to that highest up close candle, that body extended over, that right there is your bullish breaker. That is your order block. That is your immediate rebalance. That is all occurring at your daily opening price, which is this change in the state of delivery. That means what's occurring? The algorithm that you don't believe exists is now going to spool price higher. But this rally, when it runs, what is it reaching for? If there's a change in the state of delivery, it's going to seek the opposing side of what? Liquidity or inefficiency. That occurs right here. To the left, what do we see? Well, we have this little inefficiency here, but it's short order to do that. We don't need it. We don't need it just to trade here. We need it to show us a run. Right in this price fractal that I'm showing right now, where's it reaching for if it wants to go to buy side? Relative equal highs right here. And what? That high. Wasn't that convenient? Bang. So your model could be based on using this higher time frame order flow around a bullish order block, its opening price, which is not ambiguous at all. It's a very specific price level, very specific. And you drill down and you look for PD arrays to converge around it that supports the idea that it's going to do what? Go higher. Because the change in the state of delivery means it's going to start going higher. So if it's going to go higher, pray tell, what is it going to go up there for? And to where? It's going to go to any inefficiency in close proximity or buy stops. That's buy side liquidity. Friends and neighbors, that is short, sweet, to the point. You can't reduce it to anything less than that. It's right to the point. You can't make it any plainer than that. Now, the same thing we apply to this opening price on the higher daily order block. What's occurring here? The market creates a consolidation and it needs to do what? It drops down into a short-term discount. What does it trade to? The order block's opening price. When it does that, it's going to act like a trampoline. Meaning what? It's going to go down to it, press into it, and spring higher. By itself, it is not useful. You need to see other things confirm it. That's what makes it an order block. If it's just a down closed candle, that means absolutely nothing. It means absolutely nothing. The price action signatures that you're looking for is a confluence of other factors that would support the idea that it needs to be responsive at that price point, at that time. Think. What else is occurring right here when it drops down and hits that order block's opening price? What's it reacting off of? What is this? Buy side imbalance, sell side inefficiency. This is buy side delivery. It's inefficient in what? Sell side. Well, if we measure that from here to here, what are we looking for? The best buys are going to be at what? Midpoint or consequent encroachment in the upper quadrant. Where's the bodies at? Forgot about that, didn't you? The bodies are telling you, they're telegraphing you that we're going higher, but we got to damage some people first. There's some bull flag traders in here that already tried to go long, so we're going to have to stop them out. But is the algorithm just going to go pull some random number out of its ass and say, well, we're going to drop down 300 handles before we start going higher? No, it goes right down to consequent encroachment, which is the midpoint of this buy side imbalance, sell side inefficiency. See, you want it to be, this needs to stay open ideally, okay? That needs to stay open. The best buys are going to happen in the upper quadrant. What looks like a premium to you, but it's not. That's the ideal entry because you're already in a discount. We don't want that lower portion to be closed in or overlapped on. We don't want that because what that indicates is it's exceedingly bullish. This will act as a breakaway gap. That's exactly what we want. We want to see that. If we get to a consolidation place in the price run, and it creates a gap like this, where we want to leave a small portion open, that is a measuring gap. But the fact that it has to be part of a larger consolidation, or one leg of the price run's already occurred, and then we're consolidating, and then we get another gap where it creates an environment like I'm explaining here, if it stays open, that to me is going to be a measuring gap. That means it qualifies that we have another price leg that's going to be equal to the initial move, or maybe even more, but it's going to do it in 3/4 of the time that it took to make the first leg, or less. So what does that mean? Many times that's your second stage reaccumulation in a market maker buy, or a second stage redistribution in a market maker sell model. But let's dig into a little bit more detail right down here. This is an hourly chart. That's our higher time frame bullish order block, opening price. It's the change in the state of delivery. That means what was it doing? It was just dropping down. We're going to anticipate what? That trampoline, that springboard effect off of that level. We have to have something else. We already have it on the same time frame, which is consequent encroachment of this buy side imbalance, sell side inefficiency. Why? Why should you have that rule? Because ICT teaches that you don't want to see every imbalance completely closed in. That's what gives you the narrative. If it's always able to come back down and fill in every single buy side imbalance, sell side inefficiency, we're probably near the end of the price run. Think. They don't have any time to waste. If they're going to come down here, that means it's going to be a lethargic price run. I don't want to be a part of that kind of stuff. I want to be in the ones that take off and it's like, what the hell? This thing's flying. It's like hyperspace. But hourly chart, we're going to drop down to a 15-minute time frame. We're focusing primarily right in here. Okay. We already have one qualifying thing, which is the consequent encroachment of that buy side imbalance, sell side efficiency. It should leave this portion open down here. In hindsight, yes, we can see that's happened. But you want to see that lower portion not filled in. The more times you see that, man, that is telling you this son of a bitch is going higher. Stop looking for tops. Stop trying to go short. It's going higher. It needs to go somewhere higher. That's what it's indicating to you. You can't get a better visual representation of confirming and qualifying a setup than that. But the lower portion of that candlestick not to even be traded to. It can touch the mean threshold halfway point, but if it does that, it needs to immediately kick off and start running. If I'm trading a fair value gap, and I'm bullish, I want the upper portion to be responsive. I don't want to see it dilly-dallying around at all in that lower half. I don't want to see that. If I start seeing that, as soon as I see any momentum waning after it starts to run, I'm scaling something out. I'm more inclined to start taking partial. Why does ICT take this many partials off here on this trade? I just fucking told you. So we're going to drop down 15-minute time frame. Again, we're looking right at this price level right there. Same thing in here. We're looking at relative equal lows. So there's a sell side liquidity pool being engineered there. Look what they do. They run first, higher. So what does that do? It triggers longs. Why would they want that? Because if they're going to go long, they're going to put what? Sell stops. Where are they going to put them at? Below the relative equal lows. Well, then that's convenient because right down here is that order block. And right down in here is that consequent encroachment of the 1 hour buy side imbalance, sell side inefficiency. So now we have liquidity engineered right at a buy side imbalance, sell side inefficiencies, consequent encroachment or midpoint of that gap. Is that 3? That's 3. That's 3 things. We have inefficiency being factored in and liquidity now. So when it hits this price level, what should it do, ICT? It should act like a trampoline, springboard higher. Does it do so? Absolutely. So I've taught you how to look at order blocks, how to qualify them. They got to be in a discount or a premium. The higher time frame ones, you need to transpose those levels to the lower time frame. And when you go into the lower time frame, you want them to be in agreement with at least 3 PD arrays, 3 more things to justify it. The level of a order block's opening price or mean threshold is in and of itself, by itself, useless. They are the markers in which you go into price and you study around that. And if you have 3 PD arrays, 3 reasons, whether it be liquidity or specific price levels that is a PD array. Liquidity is always a PD array, and it's dynamic. It can be in any time frame, any level of premium or discount. But when it's coupled with a level that is expected to promote higher prices, it's a slam dunk. Like it's a slam dunk. There's nothing to consider about it. It's easy. It's just waiting for you to get in it. If you don't get in it, just take the next one because they're going to repeat every week, every day, and it won't stop. That's our moniker here. It never changes. It just gets more precise. It gets more detailed, more confidence building because we're not reinventing anything. We're not changing parameters. We're not moving the goalpost. We're not saying one PD array is growing in popularity, so therefore that's the better one. Any one of those PD arrays can be a catalyst. And that's why it's important for you to just pick one to warm up to first. But you're going to want to go into all of them eventually for you to get a well-rounded, comprehensive visual representation of what price is doing algorithmically. So here's what it looks like on the 15-minute chart. We'll just drop down for shits and giggles on the 5-minute chart. Last down close candle, displacement to the upside. Did we trade to consequent encroachment of that buy side imbalance, sell side efficiency and the upper opening price on the daily bullish order block, that level here? Yes. Did we see displacement? This candle? Yes. Last down close candle. What is the change in the state of delivery? What price is it? It's the opening price. What opening price is that? 17,710 and a half. Price comes down, trades to the low of that candle. What's the low? 17,709.25. Did it respond? Did it respond? Did it prove there's a change in the state of delivery and algorithmically repriced higher? You're going to tell me that's buying and selling pressure? That's buyers came in there, right? Price expanded higher. And then what do we have here? You missed this down here. You weren't able to dial in. No problem. We're on a 5-minute chart. We're in a 5-minute chart. We're still below equilibrium. So we're in what? We're in a discount. So can we take a fair value gap entry? Absolutely. Yes, we can, Virginia. So watch. Here is your fair value gap right there. See that? We're going to take this off because we've already highlighted the area to start looking for the setup. But right in here, where's the best entry, ICT? Can you just cut the bullshit and tell me how to buy a fair value gap appropriately? Tell me where to put a stop loss. Where's the best entry? How should I trade it? Okay, you listening? You're listening. This candle right there, okay? You want your entry to be in the upper portion, that price level or higher. You can save yourself a lot of heartache by just simply going in one tick below the high of it. Your risk is the low that creates the fair value gap candle. So if you look at this right here, that gives you your framework. What was the midpoint here for consequent encroachment? 17,770.25. It trades down and offers that price level plus its tick. The upper portion of an order block from its midpoint to its high, every fair value gap from its midpoint to its high, if you're buying, that's your ideal entry. Is there anything wrong with trying to buy the midpoint between consequent encroachment and the high? No, that's usually that's a sweet spot where I like to do most of my buying. My largest portion entry will be in that vicinity.